You want to understand today's action? Dow surging 147 points, S&P gaining 0.63%, NASDAQ climbing 0.54%, a rapid rebound after yesterday's hideous beatdown. I'm going to make it real simple for you. The market is a spectacular, albeit mercurial fashion show, just like the real thing. The same stocks that would strut down the market runway greeted with oohs and ahs can be pelted by tomatoes just a few weeks later. Stocks that have languished in the bargain bin for months suddenly start selling like hotcakes. When styles change, we call that a rotation on Wall Street. Investors are furiously recalibrating what they're willing to pay for. And just right now, they're happy to pay up for the stocks of solid companies with healthy dividends and ideally big buybacks. You know what? They've lost interest in the stocks of fast-growing companies when it comes to revenues that issue huge gobs of equity to pay people or come up with some bizarre new metrics to explain how they're really doing okay, even though they don't have much in the way of earnings, if any. In other words, the cloud stocks are out. Salesforce.com, ServiceNow, Adobe, Workday, Okta, CrowdStrike, Palo Alto, Zscaler. I could go on and on. These names were all smoking red hot, and now they're struggling. And you have to wonder, I know what you're thinking at home. You're thinking they were hot. Now something's gone wrong. Have the fundamentals deteriorated? Not at all. Aside from a few exceptions, the numbers remain fantastic. They're just not the numbers people want. Last night, Salesforce reported a monster quarter, and the stories about how the guidance for next quarter was weak, I'm calling them misleading. We know Adobe's been putting up terrific results. Sure, Workday and Palo Alto seems to have disappointed a little, but they still got phenomenal growth rates. So why did these stocks get hammered today? Because we got one more story suggesting that we might have a trade deal. Maybe we're getting closer to a trade deal with China than we were 2 days ago, when we first heard the murmurings that an agreement might be hard to reach. Whenever we get positive chatter about the trade talks, traders start betting on a resurgence in the global economy. And when the global economy accelerates, nobody cares about these stocks with a consistently smoking hot high revenue growth. Instead, Wall Street wants cyclical companies that were doing poorly and can post big earnings growth if we get a stronger environment.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.